Investors hear stories about the life-changing gains made from stocks like Amazon in the early days. Every dollar you invested in Amazon at its IPO price would be worth $1,200 today. Investors want to make big returns like this, but it's hard to find companies that will disrupt the way we do daily tasks, like using cell phones, shopping online, or renting movies. It can appear easier to find these opportunities by investing in the same ideas, but that haven't gone through the growth and mainstream adoption yet. The trick is to look in foreign markets. China is the biggest growth story of the past 50 years. They are modernizing their infrastructure and growing from a developing country to a world superpower. China is controlled by the CCP, the Chinese Communist Party, and they have a tight grip on who can do business in China and what kind of business they can do. China does not have Google, Facebook, or Amazon. It develops its own brands that copy the proven business models in the West. It gives preferential treatment to these companies to serve the population of 1.4 billion people. These people are achieving higher standards of living and have more disposable income, so this market has huge growth opportunities. It's easy to see how a successful business model in the West could do in China. You'll hear these terms about Chinese companies. You'll hear the Tesla of China when someone talks about NIO, or the Amazon of China when talking about Alibaba, or the PayPal of China, or the YouTube of China. But when investing in these companies, investors are putting themselves at political risk. This is the risk that the government or regulators can do something unexpected that'll hurt the share price. The CCP has given preferential treatment to these companies, but this works both ways, because the government can punish them as well if they cross the line. The companies don't even need to cross any lines, and the government can just assert control over the businesses, and there's no recourse for shareholders or even the business. Chinese stocks have been tumbling in the past 6 months. The iShares China ETF, ticker MCHI, is down 25% in the past 6 months. This is because the CCP has been cracking down on publicly traded companies and putting new regulations into place. This has caused Chinese stock prices as a whole to fall, and some companies to fall in share price as much as 90% or be delisted completely.
Check out shares of Didi plunging more than 10% and reports that China could be considering an even harsher crackdown on the ride-hailing stock. Deirdre Bosa joins us with all the details.
The company Didi Global Inc. is a Chinese ride-hailing app, the Uber of China. Didi had an IPO and raised $4.4 billion and has a market cap of around $68 billion and is the second largest IPO of a Chinese company. It IPO'd on June 30th, but on July 4th, Chinese regulators announced an investigation into Didi and demanded they stop accepting new customers and had their app removed from the Chinese App Store. The official reason for the investigation was that Didi had violated customer privacy laws. Kyle Bass, a hedge fund manager and outspoken critic of the CCP, says this was a deliberate move to harm U.S. investors and send a message to Chinese companies looking to raise funds in U.S. markets.
Chinese tech and education stocks plunging today on the latest round of regulatory pressure. Look at those moves, Steve Weiss.
A recent example of this is with the crackdown on Chinese educational companies. There's a large demand for after-school private tutoring in China. Many students will go to tutoring centers after school to help with their primary studies. The new regulation states that these companies will need to become non-profit businesses. They will not be allowed to give lessons related to the students' exams on weekends or holidays, ban all foreign curriculum, or hire foreign teachers to work remotely. This has caused educational stocks like TAL Education Group to fall about 90%. TAL is listed on the New York Stock Exchange and owns and operates many of these after-school tutoring centers. Fears are growing that companies like Tencent are next. Chinese media called video games opium of the mind and are pushing for more regulation on the video game industry. In 2019, China already put in regulations that children under 18 were banned from playing video games between 10 p.m. and 8 a.m., and how many hours they could play during the daytime. Tencent has a market cap of $580 billion and is down 7% after this report came out. One of the strangest stories about regulatory crackdowns is the disappearance of Jack Ma. Jack Ma founded Alibaba, the Amazon of China. The charismatic entrepreneur like Elon Musk or Bill Gates, he was responsible for one of the biggest IPOs of all time when Alibaba went public. He was planning a new IPO called Ant Group, a fintech company which owns Alipay, the PayPal of China. This would have been the largest IPO in history. Jack Ma gave a speech criticizing Chinese financial regulators. Then the IPO got abruptly cancelled. Jack Ma was summoned to Beijing and was not heard of again for 3 months. Speculation ran wild about his disappearance. There have been some sightings of Jack Ma, and this Forbes article examines them and finds that they were all either a video or in another controlled environment with only a couple witnesses, and he has not been photographed in public since being summoned to Beijing. It seems Beijing wants to insulate itself from US investors. It's possible they see foreign investment as a financial or political threat, and it's possible that the CCP has let these semi-capitalistic corporations grow to the point where they're stealing some of the limelight from the CCP, and now it's time to rein them in. It's important to know the extra risks involved with Chinese stocks. The premise is simple. Find a Chinese company that is trying to copy a business model of a successful disruptive company in the West, then sell that product or service to the billion Chinese citizens with growing disposable income. But the regulatory environment is becoming more uncertain for investors when even the largest companies or the biggest names in China can get on the wrong side of the powers that be and have their whole business put into jeopardy. Investors could try to reduce the risk by investing in broad Chinese-based ETFs, but the S&P 500 has outperformed these by a large margin. The iShares China ETF has performed 31% for the past 10 years, and the S&P 500 is up 227% for the same period. If you decide to invest in China-based companies, be aware of these risks involved and don't invest any more than you're willing to lose.